If you are a real estate investor, especially in a growing market like Dallas, there is a good chance you believe your taxes are fine. Not perfect, but fine. You collect your rental income. You track your expenses. You send everything to your CPA. They file your return. And on a surface, everything looks normal. But here is the problem. Most tax mistakes in real estate investing are not obvious. They do not trigger immediate red flags. They do not always result in penalties right away. And they often go unnoticed for years, until one day, something changes. You try to refinance. You decide to sell. Or your portfolio grows to a point where the numbers no longer make sense. And suddenly, those small mistakes start to show up in a very real way. So in this video, I want to walk you through the hidden tax mistakes that real estate investors often make, especially in markets like Dallas, and how experienced real estate CPAs help identify and correct them before they become costly. Let's start with something that seems simple, but causes more issues than most people expect. Mixing personal and investment finances. This is one of the most common mistakes. At the beginning, it feels harmless. You pay for a repair using your personal card. You deposit rent into your personal account. You move money back and forth without thinking too much about it. But over time, this creates confusion. Expenses become harder to track. Deductions become harder to justify. And your records lose clarity. From a tax perspective, clean separation matters. Separate bank accounts, separate credit cards, clear documentation. Without that, even legitimate deductions can become questionable. Now, moving forward, let's talk about depreciation. This is one of the biggest advantages in real estate and also one of the most misunderstood. Many investors set up depreciation once and never think about it again. But depreciation is not just a number you enter and forget. It affects future tax liability. It impacts your gain when you sell. It influences your overall return on investment. One common mistake is failing to evaluate whether a cost segregation study would be beneficial. Another is not aligning the depreciation strategy with the holding period. Accelerating deductions might help today, but what happens when you sell in a few years? Smart planning looks at both sides of the equation. Now let's shift into something that often gets ignored. Passive activity rules. Real estate is typically considered a passive activity for tax purposes. That means losses may be limited depending on your income level and participation. Many investors assume they can automatically use losses to offset other income, but that is not always the case. There are specific rules around material participation and real estate professional status. Misunderstanding these rules can lead to incorrect assumptions about tax savings, and correcting those mistakes later can be complicated. Now, let's talk about entity structure. A lot of investors form an LLC and assume the job is done. But as we discussed before, an LLC is not a tax strategy by itself. How the entity is structured, how income flows, and how multiple properties are organized all matter. One common mistake is placing all properties into a single LLC without considering long-term implications. Another is mixing different types of activities within the same entity. Rental income, short-term rentals, flipping projects, and consulting income may all have different tax treatments. When they are combined without structure, reporting becomes messy and planning becomes limited. Now, let's move into record keeping. This is where many problems begin quietly. At first, everything seems manageable. But as the portfolio grows, tracking income and expenses becomes more complex. If bookkeeping is inconsistent, errors start to accumulate. Duplicate expenses, missing income entries, incorrect categorizations. And these issues may not be obvious during filing, but they show up later, especially when you need accurate financial data for refinancing, selling, or bringing in partners. Good record keeping is not just about taxes. It supports decision-making. Now let's talk about timing. Many real estate decisions have tax consequences that depend heavily on timing. When you place a property into service, when you complete renovations, when you sell, these moments affect depreciation, capital gains, and overall tax exposure. A common mistake is making these decisions based purely on market conditions without considering tax impact. A real estate-focused CPA helps align timing with strategy, not to delay decisions unnecessarily, but to understand the full picture. Now, moving forward, let's discuss something that often gets overlooked. Planning. Many investors treat taxes as a once-a-year event. They gather documents, they file the return, and then they move on. But by the time the return is prepared, most planning opportunities are gone. The numbers are already set. Hidden mistakes often continue simply because no one is reviewing the strategy during the year. Proactive planning changes that. It involves reviewing income mid-year, evaluating potential purchases or improvements, adjusting strategies before year-end. Now, let's touch on something that becomes important as your portfolio grows. Scalability. What works when you own 1 or 2 properties may not work when you own 10. Without a scalable structure, complexity increases quickly. Accounting becomes harder. Tax reporting becomes less clear. Decisions become more reactive. Experienced advisors help investors build systems that grow with their portfolio, rather than constantly reacting to problems. Now, let's bring everything together. Hidden tax mistakes are not usually dramatic. They are small, gradual, and easy to overlook. But over time, they compound. They reduce efficiency. They create confusion. And they limit your ability to make strategic decisions. The role of a real estate CPA is not just to file your taxes. It is to identify these hidden issues early, provide clarity, and help align your structure, reporting, and strategy with your long-term goals. Real estate investing is not just about buying properties. It is about managing them effectively, and tax strategy is a big part of that management. If you are investing in real estate and you have never taken a close look at your tax structure beyond filing, it may be time to do so. Not because something is obviously wrong, but because the biggest mistakes are often the ones you do not see yet. If this video helped you understand where hidden tax issues can come from, subscribe to our channel. We share weekly insights designed for real estate investors who want more clarity and better long-term results. And if you want to learn more about how a CPA for real estate investors in Dallas can help identify and fix these issues, visit gavtax.com for more resources. Thank you for watching, and I will see you in the next video.